Getting started with investing can be so overwhelming. I mean, in the United States alone, there's over 3,800 companies who are publicly traded. Among that, tons of other assets that you could put your money into. In today's video, we're going to talk about what does diversification of a portfolio really mean, how do I go about diversifying my own portfolio, and then how does this play into a long-term investment strategy? So let's get going. So two questions everyone should ask themselves. First, how long am I looking to stay in this investment? Is it something that is really looking for like maybe a 2 or 3 year timeline? I'm going to take that money out and purchase something like my first home? Or is it something that I'm looking to stick with over a long term into my retirement years? The second question you need to ask yourself is, what is my risk tolerance? Some people like to take more chances and are okay with the volatility, the ups and downs in the market. Some people like to preserve their capital and they want to take a more conservative approach. Well, asking those two questions around time horizon and risk tolerance will identify what is the best strategy for each individual. Just as a disclaimer, every investment carries a certain amount of inherent risk. It's inevitable. But there is one investment, and one investment only, that always gives you a return. It's been a secret in the past, but I don't want it to be a secret any longer. All you need to do is tap the subscribe button below or in the corner of your screen. It's that simple. Go ahead, I'll wait. So what does diversification really mean? What is a diversified portfolio? It's the ability to take an investment and spread it amongst multiple assets so you're not overly exposed to just one. Growing up, my mother always told me never put all your eggs in one basket. It's the same thing with your portfolio. But come to think about it, I never had a basket, ever. Maybe a cooler, but not a basket. What does this mean to an investor? It doesn't mean that you're going to make a ton of money. It doesn't necessarily mean that you are not going to lose money either, right? There's inherent risk with any investment. What it does do is minimize volatility in your investment so you don't see these large swings in your portfolio. Rolling with the homies. Diversification will help preserve your capital, but also give you exposure to the upside. And that's what every investor wants. You want to try to minimize the down, but still give you exposure so that your investments can grow. So let's just make this whole concept of diversification a little bit more practical. Let's say you're going to Vegas and you're gonna play roulette. You can bet on individual numbers. There is 0, 00, and then 1 through 36. So you have a 1 in 38 chance of the ball landing on your number. Or you could bet on red or black, which enhances the probability of you winning a ton. The payout or the upside isn't necessarily as great, but the possibility of you winning is significantly greater because now your investment, or in this case your bet, is spread amongst a ton of other numbers. The first piece to diversified portfolio is US stock or domestic equities. When you purchase a small piece of these companies, you're buying what we call a share. These are companies like Procter & Gamble, Walmart, Target, Amazon, Tesla, and 3,800 others. When you purchase these shares, it is considered a more aggressive form of investing. There is definitely more volatility, so you'll see bigger swings. There is greater risk, but there's also greater reward. And that's what an investor who wants to be more aggressive in their portfolio, or who is okay or not adverse to risk, will side more heavily to US-based equities. Another asset to a diversified portfolio are international stocks. These are companies that operate overseas but are traded publicly here in the United States. Again, with any stock, there's inherent risk and there's more volatility. The one benefit to international stock is it doesn't always behave the same way a US stock will. So for example, let's say we experience an economic struggle in the United States for the next year. It doesn't necessarily mean that companies who operate overseas are going to experience that same sort of pain. As a matter of fact, they might not only just survive, they might thrive during a US economic downturn. So the benefit of international stock is it doesn't necessarily behave the same way that a US stock might. Bonds Bond. James Bond are another common asset found in diversified portfolios. But what is a bond really? It's a loan to either a government or a corporation over a set period of time. During that time frame or the term of that loan, you receive interest payments usually every 6 months. Common bonds include treasury, municipal, corporate bonds. And what investors really like about bonds is that they generate interest. They're extremely less volatile compared to stocks, both domestic and international. But vice versa, they don't have the same upside potential. So you're not going to see the same growth traditionally from bonds as you would in equities. Money market funds are also used to diversify a portfolio. They're very, very stable and they give you access to your cash and help preserve cash. However, the return on a money market fund is very low, usually less than 0.25%, and they're also not insured by the FDIC. In 1993, ETFs, or exchange traded funds, were created. And this makes diversifying a portfolio a lot easier. An ETF is a bundle of stocks, bonds, or other assets that are grouped together and then sold on the market just the way a traditional stock would. So instead of having to buy all the FANG stocks, you can buy an ETF that includes all those companies, and that way you own a little piece of all of them instead of buying individual stocks of each company. Right here alone in the United States, there are over 2,100 ETFs. That's a lot to choose from, and where do you even start? In a future video, we're going to cover how to actually screen ETFs. That way you can make the best decision for your own portfolio. Mutual funds are similar to ETFs, but not exactly the same. It's a pooling of money that is then used to purchase other assets like stocks and bonds. These funds are also managed by professionals. So the good side is you have a professional who's overseeing the fund. The downside is the fees associated with mutual funds are usually greater than ETFs. There's some other small differences here and there, and we'll go through those in a later video. So what are the right proportions? What's the best way, or what is the right mixture in order to create a balanced, diversified portfolio? And it goes back to that early question, and it's different for everybody. What is your time horizon and what is your risk tolerance? For me personally, I tend to be on the more aggressive side. About 40% of my portfolio is in stocks, mostly domestic with a little bit of international exposure. I have another 40 to 45% in ETFs. Again, some of those have some international exposure as well. And then lastly, I have a very small sliver of bonds and a very small amount in just cash sitting on the sidelines. Experts suggest that age plays a role in the way we should invest. If you're someone who are in your latter years and you're getting close to retirement, bonds are great because they provide an interest-based income. Where if you're someone who's a little bit younger, I myself, I'm 35, I tend to be on the more aggressive side because I have a lot more working years left in me and I have time to make up any of the losses that I might suffer here in the short term. So I tend to be more aggressive, but again, go back to time horizon, go back to risk tolerance, and that's how you figure out the best strategy for you. In a long-term investment strategy, diversification allows you to minimize volatility while still giving you upside exposure. And that's exactly what every investor wants to create a strong, consistent portfolio. If you want to get started investing but haven't just yet, take a look in the description below. We created a video of the step-by-step guide on how to buy your first stock. You'll also find links to different brokerages so that you can open your first account and get your portfolio going. Until next time, save, invest, and grow.